Okay, well, this video is all about stocks. And well, not all about stocks. This is kind of the intro to stocks video. And so we'll cover what a stock is, how you buy one, and how it differs maybe from some other types of investments that maybe you've heard about. But I think to get started, the most important place to return to, if you haven't been there already, is to understand the balance sheet of a company, because then you'll really understand where stocks fit in. And if you remember, if you've watched the balance sheet video, and if not, here's just kind of a quick summary of some things that we cover in there. But with a balance sheet, you have assets of a company here. You have liabilities here. Another word for liabilities might be debt. And then down here you have equity. Okay. Now, when we're talking about stocks, we are talking about this part of the balance sheet, the equity piece. Okay. So when you buy a stock of a company, you're buying a part of its equity. Now, you'll remember that the assets show what a company owns, and let me just do it this way. This side shows what a company owns. This side shows how it owns those assets. Okay? So they can own assets two different ways. You can either borrow to buy them, or you can raise money from selling equity or selling equity ownership in the business to buy them. Okay? And so a stock, this is where stocks come into play, fall down here in the equity piece. So when you own a stock, you own a piece of the company. You own equity in that company. And just to draw a quick comparison, and we won't talk about them at all in this video, but if you hear of bonds, those are up here. So if you buy a bond, you're buying the debt of the company. They are raising money to purchase assets or to expand their business or do something else by selling debt. If you own stock, that means that you've purchased part of the equity, and then they're raising money by selling a piece of the company. Okay, so let's just, as an example, you have Coke or Coca-Cola, right? It's a business, and it's a corporation. Corporations can sell stock. Okay, they're the only type of legal entity that can sell stock. And so if you go and you look online at Yahoo Finance or somewhere else, and you see that Coke is trading for $10 a share, that just means that in today's value, if you were to go out and purchase one share of Coke stock, it would cost you $10. Now let's say that, now this isn't the case obviously, but let's just say that Coke, the company Coke, has 100 shares of stock issued all together. They're only offering 100 shares to trade. If you purchase one share of stock, then you own 1% of the company. If you purchased 10 shares of stock, you'd own 10% of the company. Okay? So, most folks like you and me are probably way underneath even this level. We might own 100 shares of Coke stock, but there's several million shares outstanding. So those of us who are ordinary investors will own way under 1% of a certain company. But investors like Warren Buffett, he has enough capital where he can buy, 1%, 10%, or even more of a certain company. And then he really has some influence over how that company behaves and what it does. But to keep it simple, again, buying a share of stock means buying a share of the equity ownership of the business, buying a share of the equity. And that means one of the things that comes along with owning stock is you have an opportunity to vote. So even if you only own one share, that's enough, and it gives you the right to vote on issues that the company wants you to vote on. That's one of the primary benefits of being a stockholder. Okay. The other thing to take note of is that, say that when you purchased the stock, it was trading for $10 a share. But if the business does well and the market thinks that the value of the stock is actually higher, and it really does this every minute of every day when you look on Yahoo Finance or somewhere else and look and see where that stock is trading. But if it suddenly goes to $11 a share, then that means that you've made a gain of $1 per share gain. Now, they don't send you the dollar. That dollar is just it's a paper gain, which means that you only see it on paper until you actually have to sell. In order to actually get that dollar, you actually have to sell the stock. And then, you pay yourself back the $10 that you paid, and then you get the $1 of gain. And in this case, it's called realized gain. Okay? So most people, when they buy stock with two ideas in mind. One is that the share value is going to go up, like it did here, from $10 to $11. The other reason that people buy stocks is that some stocks pay dividends. And what is that? Dividends is kind of like interest, but when a stock pays a dividend, it usually pays it on a per share basis. And the company gets to decide how much this is. The stockholders don't really have any control or power over dividends. But let's say that the company decides that it's going to pay a dividend of 20 cents a share. Then if you own 10 shares, right? 10 shares times 20 cents, that means that you would get a check for $2 in the form of a dividend. So that's another way to earn income from owning the share. Even if the stock never goes up above $10, if the stock pays a good dividend, you're going to be making $2 per year, because dividends are on an annual basis usually. So you're going to be making $2 a year. Well, that's not bad, because if you at $10, if you own 10 shares and you paid $100 for them, this is a 2% return, right? Again, if you purchased 10 shares at $10, let's just kind of do the math up here. Sorry, it's getting a little bit. If you did 10 shares times $10 equals $100 is what you spent, right? Well, if your dividend is $2 and you spent $100 to buy those shares, then your dividend percentage or your dividend yield is 2%. Well, if the dividend were a little bit higher than that, you could actually get 5 or 6% maybe on a dividend yield, which if you looked at bank accounts recently, that's a whole lot higher than you can get by putting your money in the bank. However, when you buy a stock, there is no guarantee, right? Let's make this in big red letters. No guarantee of much of anything. The company can decide to take away this dividend anytime it wants. The market can send this $10 share down to a $5 share if it doesn't like something that's going on. And so the dividends are in question, the share value is in question. So you really have to do your homework and know what you're buying before you want to buy shares of stock. But this gives you just a sense for where it fits in the overall investment portfolio, or in terms of how it's created. When you buy a share of stock, you're buying this piece of the balance sheet of a company, right? The equity piece of the balance sheet of a company. We'll have a separate video on bonds, which you should take a look at and understand the differences there. Okay, we'll have more videos on stocks, but this is a good introduction. We'll see you in the next video.